Hey friends, week 2 here, and we're talking a little bit about financial analysis, and we've got some ratios, and we're also talking a little bit about forecasting. So I want to start today just by talking a little bit about decision making when it comes to our faith and a Christian perspective about these things. And it may not be a super familiar passage for you, but it's out of 1 Corinthians chapter 16. This is what Paul the Apostle says to the church there in Corinth. Concerning the collection of money for God's people, you should do what I directed the churches in Galatia to do. On the first day of every week, each of you should set aside whatever you can afford from what you earn, so that the collection won't be delayed until I come. Then when I get there, I'll send whomever you approve to Jerusalem with letters of recommendation to bring your gift. If it seems right for me to go too, they'll travel with me. So what's going on in the background is that the Apostle Paul has been traveling around serving these different churches that are not primarily of Jewish descent. Some of them are, but many of them are Gentile churches as well. And they have heard through Paul and through others that Jerusalem, the kind of mother church, is under great persecution, and that there may be a famine in the land, and there's some things going on. And so as they group together what they need, they want to make sure that no one, and this is a theme in the book of Acts, no one has need, that people's needs when they come up are met. And so, and those who have more than they need often will sell or give. And that's what Paul is basically inviting them to do, is to take stock each week of what they have and set aside some of that to help others. So there's some great generosity principles here, but I want to focus in on this idea of every week setting aside what you can afford. I think there's a lot that happens in corporations and in personal finance that comes down to small disciplines every week. Shorter, more frequent disciplines. And so as a financial manager and as someone who informed by your faith, whether you're a Christian or not, you can be informed by the wisdom that God teaches us through the scriptures, through trusted companions along the way. And that can help lead to a life of service to your company, of service to your family, of service to yourself and to others around you. And that's what we want to form as good financial managers and decision makers, is disciplined habits today. And so that's where a budget comes in. That's where accurate information, that's where the idea of having some liquidity in our assets. That's why it's not enough just to say that we're profitable because we had a profit this month, but it is to look at the trends and to shift the trends. To make a change would require actually decisions that kind of come down to the mundane, everyday moments. So what Paul invites them to do is not wait until he gets there and take a big collection, but to discipline every week, setting aside some money. And so the same could be true for you as a financial manager. If you're wanting to be prepared, you might need to do something like fund depreciation, where you're setting aside money for your depreciating assets in the anticipation that in some time in the future, you're going to have to pay for a large asset, whether it's like a large HVAC unit on your building. Maybe it means that just because you're profitable right now doesn't necessarily mean that you're going to be profitable once you have to build a new physical plant. If you're at capacity and you're at production capacity and you're profitable now, will you still be profitable if you have to build a new plant or physical plant? Well, set aside some money now, be investing in things that are liquid, so that when the opportunity arises, you can make those strategic decisions. And I think so that you can also be generous. Generosity and things that we've talked a little bit about, how corporate sustainability and these other things come into play. And they are things that we are willing to invest in, that are for the future, that are not necessarily going to hit the bottom line, and yet they have great, great impact on a company's goodwill. So as a financial manager, you want to bring to bear this this idea of discipline. And if you can't be disciplined with your own personal finances, it's going to be very hard for you to translate that to discipline in the corporate world when it's not your personal money. As a financial manager, you may be managing a large budget. And if you're not able to be on a cash budget for yourself, likelihood you're going to be a little bit more reckless with the company's budget. Good habits in your company, good habits in your personal life work together. And one of those is a discipline of looking at the money you have today and set aside a portion of that for future projects and for generosity, things you can do with it. So let's get into week 2's lecture. We're going to talk a little bit about financial analysis, ratio analysis, and how we evaluate a company's financial performance and position so that we can make good investment decisions. So part of what you're learning in this course is not just to be a good financial manager yourself, but maybe also to invest in and be a good investor in other companies. So you take a look at the financial statements and address the financial health and performance in contrast to other companies. And that's where the ratio analysis come in. They help us measure the liquidity and performance of a company in relation to other companies in the same industry or to the industry average. So you hear that, like they're performing above the industry average. Well, where does that come from? Well, that comes from the ratio analyses that they do, ones that you have in your text and part of your homework this week. There's several different types of ratios used in financial analysis. You'll learn about and read about the profitability ratios, liquidity ratios, solvency ratios, efficiency ratios, and market value ratios. And they each provide a different insight into the financial health of the company. As we look at them, many of them have kind of a quick look at them because they're you've got a numerator and a denominator. So most of the time the things include things like return on assets, return on equity, gross profit margin. These are all examples of how you might have your assets divided by your cost or different liabilities. And then you've got your kind of liquidity ratios, which are the ability of a company to pay its short-term liability. So that might be like if you've got your sales, but then you also have accounts payable and you've got accounts receivable. So typically a company will have something like a 30-day accounts payable or a 60-day or 90-day. And they'll then also have versions of 15, 30, 60, or 90-day accounts payable liabilities. And so if they owe money on a 60-day term, but they're only going to receive money on a 90-day term, on your balance sheet, it might show that you have that money because you've made those sales and you have an accounts receivable outstanding for those sales. But you need to pay your debt, otherwise you're going to have to get a higher interest credit to pay off your payables, your accounts payable that might be due sooner. And that's where like things like the cash flow statement come into play and can give you a clue. And so then you use the liquidity ratio to figure out where are they at currently, what's their quick ratio, what's their cash ratio. And as we say in accounting, cash is king. And so you could think about liquidity as being cash. It's not always the case that liquidity means cash, but for the most part, if you can quickly convert it to cash, be able to pay off your short-term liabilities, that means you have a high liquidity. Then your solvency would be the ability to pay off long-term debt. So if liquidity is short-term, solvency is about the long-term debt. And again, you could think about this, the difference between liquidity being able to pay your credit card debt versus solvency being able to pay your mortgage and pay off your long-term debt. So your house mortgage is kind of a long-term debt. Your credit card is a short-term debt. And so those kind of things come into play. An efficiency ratio is the ability of the company to use its resources efficiently. Those are kind of a little bit less common things that we run, but they're important as you think about how they use accounts receivable, assets. If the company has a lot of physical assets, you'd want to take a look at their efficiency ratio. A lot of these things come up in manufacturing. Market value ratios are relative to its book value. And so you might have the price earnings ratio, the price book ratio, and the dividend yield. And these are more investment related things. Market value has to do with something that isn't necessarily got a cash value today, or that cash value changes with the market. And so up and down as an investment. Technically, home prices and home values are also market value, and so you could do that as well. But for the most part, you've got your examples of those things would be investments, bonds, stocks, those kind of things. These ratio analysis are really, really helpful, but remember, we should be using them in conjunction with other forms, like as we're doing the forecasting method, as we talk about in chapter 4. We want to make sure that we're looking at not just the snapshot of the company's financial performance, meaning the ratio today, but we're also taking a look at kind of the trend analysis. How is this company doing over the last 10 years? And then forecasting for the future to figure out what the company is forecasted to do. And that comes into the next part of our lecture, which is talking about the future performance of a company or an individual's financial situation. So it's not just to say that historically they've done well and that they're doing well, but we also want to forecast for the future. There's two main approaches to that, and it's qualitative and quantitative. Qualitative is a little bit more complicated. Quantitative is more numbers-based. The quantitative forecasting relies on objective data such as historical performance and economic indicators. The qualitative kind of relies on this subjective information such as kind of industry trends, maybe a competitive analysis, and hopefully some expert opinions. Again, you're receiving information from financial experts, market experts, someone in that industry about the demand for products. And so you're looking at economic things, and you might have to rely on a trusted expert, whether that's an auditor, an accountant, or for somebody who's an industry expert. If you're in manufacturing, someone who's in that manufacturing industry, or if you're in a service industry or hospitality industry, some expert opinion can come into play when you're doing forecasting. But you want to make sure that you're doing your forecasting accurately. And that means that you probably want to do a combination of both qualitative and quantitative. And that's where the pro forma statement comes in. It's pretty in depth, and it's something that you need to gather all of the things like the income statement, the balance statement, the statement of cash flow, and work together to put together this forecast. And it may seem a little bit too much work in this class to do it, and we've got financial spreadsheets that are already kind of constructed this way. But you should know how to do it, and you should know what it takes to create a pro forma statement, because that's what you're going to use if you launch your own business or an entrepreneur. That's part of your business plan, will be a pro forma statement to forecast future earnings and profitability. And it's going to help you identify any trends or patterns that may be useful in predicting future performance for the business. It's important to be realistic, though, when you create these, because overly optimistic forecasts can really do damage to not only your investors, but your credibility and trust. And again, that's what we're really after, is developing good decision-making skills in this financial management course. It's important that you review these, and that any discrepancies with the financial statements as they kind of build together, that you investigate those. So if for some reason something isn't working out between the balance sheet and the cash flow statement, or you identify something that seems to be a discrepancy with the income statement. You want to chase those down before you commit and actually develop the pro forma statement. As we look at these statements and forecasting, just a note that as you're developing the formulas here, there's some formulas at the end of the chapter and some things that you might do for homework. And I just want to identify again that sometimes it's confusing that when a company is operating at its full capacity, in contrast to those operating in less than full capacity, again, these are primarily manufacturing examples, be sure that that they can't, that you understand when you're doing one of the homework problems, or that as you're advising them, a company cannot increase output if it's at max capacity without adding more fixed costs. That's usually physical plant or employees or those kind of things. But when a company is operating at less than full capacity, the firm can produce more goods without making additional investments in plant and equipment. So again, remember, you've got your fixed cost and your variable costs. And one of the things that gets wonky in forecasting is if you forecast right now that, well, we have capacity at our current physical plant and with our physical equipment to go from 70% right now to 100%. But if you project that they then go from 100% capacity to 150% capacity, you need to take into consideration the fixed costs that need to be increased, because your fixed costs are slightly different than your variable costs. And if you only add the variable cost and you keep the fixed cost at what it is right now, your forecasting will be off and your company potentially won't be as profitable. Especially if you've got constraints like land. And so if your property can't be increased, or you need to sell and buy a different physical plant, there are other things to take into consideration there. And so that's where these ratios are helpful. But if you put the wrong information into the ratio, then your forecast will be junk and it won't be accurate, and your decision making will be lacking. So it may seem tedious to do all of these mathematical formulas, but again, for the most part, you can Google the formula, you can watch the lecture videos about how to use the Excel spreadsheets. You don't need to be an expert at the math itself. What you need to be an expert at is making sure that you're problem solving and plugging in the correct data into the formula. So you don't need to understand exactly how each formula works as much as you need to know what to put in each one. And you're kind of doing the word problems of sorts. And this company is doing this and wants to increase its sales. How does it do that? Well, you need to recommend the decision. Do they expand their physical plant? Do they increase slowly their demand? Do they need to buy more marketing spots so that they can increase demand before they increase production? All those kind of economic and problem-solving things are bringing together kind of the spheres of accounting, of economics, and business, and you're getting to recommend decision-making. So, small, short-term, disciplined decisions help today lead to a better tomorrow. Something we can forecast if we use the correct information and we plug it in. So I hope that you are excited about these chapters about not only the liquidity of a company and looking at the ratios, not only about the future and the way in which we can forecast the performance and health of a company, but also some of the nitty gritty of actually like plugging in the numbers and looking at the different companies. And so